Greetings. Today I want to talk about how banks create money out of thin air, as a lot of people like to phrase it. And I'm not talking about central banks or monetary authorities that can literally decide to create money or create currency in this fiat currency system we have in the modern world. And they can do that. They can just decide to create money, and I talk about that in other videos if you want to check that out and the problems associated with that. But today I want to talk about how commercial and retail banks create money out of thin air, and they do this through a process called fractional reserve banking. And in this video I want to talk about this process and explain it to you, especially if you don't know how it works or you're not too familiar with how it works. And I also want to discuss the problems associated with fractional reserve banking and how commercial and retail banks can just create money out of thin air, as people like to phrase it. And by the end of the video, I want to offer an alternative banking system, one that fixes the problems associated with fractional reserve banking. So my motivation for creating this video is really because I think the monetary system we have today is flawed. I can talk about fiat currencies and how the problems fiat currencies have, and I do talk about that in other videos, and I have made other videos about this, but today I am talking about another facet of the monetary system that I think have flaws. And I'm motivated to do this because I think it's important for people to understand the monetary system, which is basically how your money works. It's important to understand money, basically, because you use money in your life, and money is used for a lot of things. You need to use it to acquire things. You get money from selling things, so you could use it to purchase or invest, and it's important to the economy, it's important to people's lives, and it's important to understand that. And I'm also motivated to make videos about this because I want to encourage people, especially those who are more inclined towards action taking, to push towards a better monetary system, one that is more reliable and more stable and more based on a solid foundation, something that people can really feel good about and feel secure about, something people can really feel like they have possession over their own money and their own currency and their own savings, instead of the system we have today, which is, in my opinion, unstable and can be unreliable if the government is incompetent, because basically your money is by a large part controlled by the government because of fiat currencies, because the monetary system today is made up of fiat currencies decided by the government, controlled by the government. You don't really have a lot of control over it. It's not backed by anything like it was before in the past, when it was backed by gold, where you actually have a solid backing for the money you have. So before, there was a gold standard, and you could just exchange your currency for gold, and gold has inherent value. So there was a solid foundation to the money you had before. And I do talk about this in other videos as well. So basically that's my motivation, because I think the monetary system is flawed, and I want people to understand money and to understand the monetary system and the problems associated with today's monetary system. And I want to encourage action takers to push towards a better monetary system. So now let's talk about fractional reserve banking. Maybe a lot of you know what it is, but for those who do not know what fractional reserve banking is, it's basically a system of banking where the bank holds a fraction of your deposit, which is called the reserve, and lends out the rest. And I think a good way to understand this is through an example. So let's say you deposit $100 in the bank, and let's say the reserve requirement that the bank adheres to is 10%. So the bank holds $10 of the money you deposited in reserve in case you need to withdraw money, and they lend out the rest. They lend out $90 to someone else, and it ends up in another bank account, and now there's $90 in another bank account and $100 in your bank account, even though the bank is only holding $10 of your deposit. So that's $190 in the banking system. And then the bank lends out 90% of the deposit in the other bank account, that $90 that ended up in another bank account. So that's $81 lended out to someone else, $9 they're holding in reserve in the second bank account, and you add $81 to the money supply originating from this $100 deposit. So now it's $271. And you can keep going with this thought experiment, and if you calculate it using mathematics, you'll find out that this $100 deposit will end up becoming $1,000 in the money supply. This $900 increase from just $100 deposited. So this is a huge expansion of the money supply, and this leads to inflation, and inflation leads to the devaluation of the currency you hold, and that devalues the purchasing power of your savings. The money you have is now weaker. It can't buy as much now as it did before because of inflation, because of the expansion of the money supply. So you may be wondering why banks are able to do this. And the reason why banks are able to do fractional reserve banking is because a lot of people keep a lot of their money in their bank accounts. They don't often withdraw large amounts of money all at the same time, which would lead to a bank run. So banks can keep some money in reserve in case people need to withdraw some money. And since a lot of people keep large amounts of money in their bank accounts, banks can lend out these deposits and collect interest from these loans. And that's how a lot of commercial and retail banks make money, by lending out your deposits and collecting interest from these loans. And obviously there's a huge flaw to this system, and that is the risk of bank runs. If people withdraw large amounts of money from the bank at the same time, then the bank might not have the reserves to give out these deposits, and that can lead the bank to fail. So that's a huge problem with fractional reserve banking. So first, it's the inflation and the devaluation of your currency, which stems from inflation. And secondly, it's the risk of bank runs, which can lead the bank to fail. Now I want to talk about an alternative system of banking. A system of banking that would address these two major problems associated with fractional reserve banking, and that is full reserve banking. Full reserve banking is exactly what it sounds like. It's a system of banking where the bank holds your full deposit in reserve instead of lending a large amount out from your deposit and collecting interest from these loans like they would in fractional reserve banking. So obviously you can see how it fixes these two major problems with fractional reserve banking, because if the bank is holding your full deposit in reserve, and they are doing so for other banking clients as well, then if a lot of people, including yourself, or whether or not you include yourself, it doesn't matter, but if a lot of bank clients want to withdraw large amounts of money from the bank at the same time, the bank has the reserves to return these deposits, so the bank wouldn't automatically fail due to a lack of reserves if such a situation arises. And the other thing is, there isn't a inflation problem. There isn't an artificial expansion of the money supply like you would see in fractional reserve banking, because the bank is keeping your full deposit in reserve and not lending it out to other people. That $100 you put in the bank is $100 in the money supply. It isn't lent out to other people to expand the money supply to $1,000 in case of a 10% reserve requirement, and that would lead to a huge expansion of the money supply, and that is associated with fractional reserve banking. That's what happens with fractional reserve banking. So obviously you see how it fixes these two problems, but you might be wondering how the bank makes money if it can't lend out your deposit and collect interest from these loans. Now, there can be demand deposits with full reserve banking, and there can also be time deposits in this full reserve banking system. So demand deposits are deposits where the bank would hold your full deposit in reserve and make it available to you for withdrawal whenever you want. And this is a service the bank is doing for you. And then there can be time deposits, and a time deposit is a deposit that is held for a certain amount of time. You're not supposed to withdraw money from that deposit until that time period has elapsed. And what the bank does with time deposits is it would lend it out to other people and collect interest from these loans, and the bank can make money from these time deposits. And often the bank offers clients higher interest rates with time deposits to incentivize them to make time deposits. And after that time period has elapsed, you can collect the money you deposited plus the interest the bank offers you. And the bank also collects its own interest and makes money from that through the loans it makes from time deposits. So it can make money from time deposits, and the demand deposit, however, is something they do for you. It's a service they do for you. So they can charge you fees for demand deposits, because unlike fractional reserve banking, in full reserve banking, the bank isn't lending out your deposit, your demand deposit, and making money from these loans, collecting interest from these loans. So they can charge fees, or they can require you to make a certain amount of time deposits for certain periods of time to cancel out the fees for your demand deposits. And I can envision a system with full reserve banking that is based on a point-based system where you have fees for demand deposits, but there's a point-based system with time deposits. So when you make time deposits for certain amounts of money and for certain periods of time, you can collect points, and these points can be used in place of fees for your demand deposits. So that's a system that I think could work out with full reserve banking, and that gets rid of the problems of fractional reserve banking, the major problems of inflation, the expansion of the money supply, and the major risk of bank runs where lots of people want to withdraw lots of money from the bank at the same time. So that's an alternative system of banking that I think would be a great alternative in fixing the problems associated with fractional reserve banking. So that's something I want to talk about today. If you think full reserve banking is a great alternative, then let me know your thoughts. We can discuss this in the comments. And if this is something new for you, new knowledge for you, and you learned new things today, then that's great. And I hope you learned a lot. And even if you already know about fractional reserve banking and full reserve banking, and you're pretty familiar with the monetary system, I hope this discussion did provide some good insights for you and leads you to think more about the monetary system and the flaws we have in today's monetary system, and the alternatives that we can consider and we can push for, so that we can have a better monetary system that is more reliable and more secure and better for us. So I hope you enjoyed my video. If you did, please like my video, comment your thoughts, and subscribe to my channel. I'll see you in the next video.